Chapter 3, Taxes. We all have to pay them, so we might as well get this out of the way early on. Here are our learning objectives for this chapter. Basically, we want to understand the U.S. tax system and how we can minimize the taxes we have to pay. So we need to identify the major tax types, calculate taxable income and the amount owed for the federal tax, prepare a federal income tax return, and look at some appropriate tax strategies for various life situations. Most of us get serious about our taxes early each year. Some start as early as January, but a lot don't really start till April, just ahead of the April 15th deadline. Bad strategy. Tax planning should be a year-round exercise. We need to know what the tax laws are, which ones affect us, and how to take advantage of any changes. We need to take taxes into account when making investment and purchase decisions, as well as charitable contributions. Our goal is at the bottom of the slide. Pay our fair share, but no more. When thinking of taxes, we all immediately think of the IRS on April 15th, but there are other taxes relevant to us. We all pay sales tax, and they vary based on where you live. As an example, right here near the DeSoto campus, the South Haven, Mississippi rate is 7%, but West Memphis, Arkansas, Memphis, and Germantown are 9 3/4, a 2.75% swing within just a few miles. Taxes on property include both real estate taxes if you own your home, and some states have personal property taxes. Taxes on wealth don't kick in until you die, so we'll talk more about them in the last chapter on estate planning. The big one, income tax and Social Security. That's where our focus will be. I hope most of you are preparing your own taxes, so much of this will be familiar to you. The first step is to determine your adjusted gross income. This is where taxable income comes from. Taxable income includes earned income as well as investment and passive income. An exclusion is money not included in gross income. The example given in the text is a portion of U.S. citizens' earned income outside the U.S. Tax-exempt income is not subject to tax, for example, income on municipal bonds. Tax-deferred income is income that will be taxed at a later date, usually at retirement. Gross income is adjusted by contributions to IRAs and Keogh retirement plans, alimony payments. A tax shelter is a type of investment that provides immediate tax benefits. Adjusted gross income is reduced by deductions. The standard deduction or total itemized deductions are subtracted from adjusted gross income to obtain your taxable income. On December 22, 2017, the Tax Cuts and Jobs Act was signed into law. It included reductions in tax rates for individuals, larger standard deductions for all taxpayers, as well as limits to other more commonly used deductions. Each taxpayer receives a standard deduction. As of 2021, the standard deduction is, for a single taxpayer, $12,550, married couples filing jointly, $25,100. Higher deductions are allowed for blind and those over 65. With these higher standard deductions, fewer filers qualify for more than the standard deduction by itemizing their deductions. Itemized deductions require more complex filing, but the higher deduction can be worth it. Including in itemized deductions are medical expenses if they exceed 10% of adjusted gross income, state and local income tax limited to $10,000, interest on your home mortgage or second mortgage loans, as well as interest on investments, but they all have limits. Charitable contributions are deductible, but you should maintain careful records and receipts for both cash and property donated to a verified 501c3. Deductions are subject to limitations if over 20% of adjusted gross. Casualty and theft losses, moving expenses, and unreimbursed job-related expenses were deductible, but were eliminated in the 2010 Tax Reform Bill. For all deductions, you should maintain careful records and receipts, just in case. This is Exhibit 3.1 in your text. It outlines the steps in filing your income tax return. Step 1, determine your AGI. Step 2, take deductions to compute taxable income. Step 3, calculate your taxes owed. Step 4, make the payments. Step 5, avoid the penalties. File. This is Exhibit 3.2 in your text. It outlines the 3 basic areas of records you need to maintain for tax purposes: tax forms and filing information. Pretty obviously, You should keep copies of your tax returns. I think in the last chapter we said at least 6 years, 7 years is better, 10 years is even better than that. If you file electronically, keeping the copies is no problem. You need to have the Social Security numbers for all family members covered on your tax returns. And you should also keep any instructions you used in preparing those taxes. The second category is income records. Here's the basic rule. Income is not negotiable with the IRS. If you got it, you need to report it or be absolutely sure that you don't need to. You may receive a W-2 form from your primary employers, a W-2P for any pension distributions, 1099 forms for interest, dividends, capital gains from investments, 1099 forms for any self-employment income, and lump sum payments from a retirement account. If income is non-negotiable, deductions are, but you need to keep careful records of all expenses you plan to deduct in case you get audited. Receipts for medical and dependent care, receipts for all charitable contributions, receipts for job-related expenses, the 1098 form from your mortgage company detailing interest and taxes paid, any expense documents for businesses or investments that generate income. Step 3. Calculate the taxes owed. Personal income tax rates are progressive, meaning the rate increases as the income level increases. Rates in the table are marginal rates, meaning they represent the rate you pay on the last dollar earned. And we'll see the 2021 rates on the next slide. Here's the 2021 tables in the text for single, married filing jointly, and head of household. And here's an example. If you're married filing jointly and have a taxable income of $95,000, you and your spouse are in the 22% tax bracket. You pay 10% on the first $19,750, so $1,975. You'll pay 12% on the difference between $19,751 and $80,250, or 12% of $60,499, another $72.60. Finally, $95,000 is in the 22% marginal bracket, so they'll pay 22% of the difference between $95,000 and $80,251. 22% of $14,749, $32.45. Total those up, their total tax, $12,480. The alternative minimum tax has been an issue for many years. It was originally designed so that high-income taxpayers couldn't avoid paying their fair share. Over the years, incomes and tax brackets have increased, but the AMT levels did not. So some years, many middle-income taxpayers got caught by the AMT. Tax credits, very valuable. They directly reduce your taxes owed. Earned income credit is aimed at working parents with taxable income below a certain amount. Foreign tax credit avoids double taxation. Savers credit encourages savings for retirement. There are adoption credits, education credits, child credits. If you think you're eligible for any of these, take the time to investigate the requirements because they can make a big impact on the taxes owed. For the majority of us, taxes are withheld from our paychecks on a periodic basis based on our claimed filing status and number of exemptions. People who receive a lot of their income from sources reported on 1099s may be required to pay estimated taxes quarterly. Needing to pay quarterly and not doing so can result in penalties at tax filing time. If you don't think you can get your tax return together and ready to file by April 15th, you can file Form 4868 to obtain an automatic 6-month extension. The caveat is you have to estimate taxes owed and pay that amount by April 15th with the Form 4868. The extension gives you until October 15th to file your completed tax return. Just for your information, most tax preparers automatically file extensions for themselves since they're busy preparing taxes for clients. Refunds can be claimed within 3 years of filing the return, and the IRS will pay you interest. Learning Objective 3 deals with who's required to file an income tax return. Basically, all of us. If you're a citizen or a resident of the United States or a citizen residing in Puerto Rico, you have to file. There are 5 filing statuses, but most of us fall into one of the first 2, single or married filing jointly. We also have married filing separate returns, head of household, which is a single individual with dependent children or relative, and a qualifying widow with dependent children. There are hundreds of tax forms, but we want to focus on the main 1040 options. The 1040 EZ and 1040A were both eliminated with the new tax laws. There's only one form now, 1040. If you're older, you can use a 1040 SR, which is the 1040 form with larger print. The sections of the 1040 basically follow the steps we've covered. Fill in your filing status, record your income, record any additional income, enter any adjustments to income, compute your tax liability, enter any other taxes, record any payments already made, enter tax credits, refund or amount owed. Refunds can be direct deposited. Taxes can be paid through direct debit to your account. The most common mistake is failure to sign your return. Electronic returns are digitally signed. If you find after you filed that you made a mistake, you can file a 1040X to correct it. Better to do this before the IRS contacts you, especially if it involves unreported income. States with state income taxes are usually due on April 15th as well. Mississippi does have a state income tax. Tennessee has a Hall tax on investment income, which is being phased out. You need to check with your state for more details. Filing online is now much more common than filing on paper by mail. Over 90% according to the IRS. No more lines at the post office late on April 15th. Unless you qualify with low income, there's a cost to e-file. It's usually between $15 and $40. The Free File Alliance is a partnership between the IRS and tax software companies to allow lower income filers to file online for free. The slide and the text detail the steps to access Free File. If you believe you may qualify, check it out. Tax preparation software has significantly reduced the time and effort in filing your income tax. The two most widely used confirmation are Block and TurboTax. I highly recommend that everyone file their own tax returns. It's the only way you'll understand how your financial actions over the year affect your taxes and how to make changes to reduce your tax burden. I have personally used TurboTax for many years. It definitely reduces the time involved. In addition, data carries over year to year from your previous year's TurboTax return. If you have an investment account, you can pull data from it directly into TurboTax. In addition, there's an outside free product called It's Deductible that organizes and values charitable deductions of property such as clothes and appliances and imports it into TurboTax. Using tax software does require a system capable of handling it, which most nowadays do, and some comfort using a PC, which you should all have. Tax assistance is available from a variety of sources, some better than others. The IRS provides a variety of sources on their website and in person at IRS offices. Note, however, they do not guarantee correct answers given by telephone or in person. There are a variety of tax publications available as well. Most well-known, probably J.K. Lasser's and Ernst & Young, as well as a free publication from the IRS. The Lasser and E&Y versions are available from Amazon. There are many online sources, but be careful who you take tax advice from. Over 40 million U.S. taxpayers pay someone to do their income taxes. The fee for this service can range from $40 at a tax prep service for a simple return to more than $2,000 to a certified public accountant for a very complicated return. If your tax situation is especially complex, you may want to consider employing a tax professional to prepare your return. There are one-person offices as well as national chains like H&R Block. The IRS has what are termed enrolled agents who are approved experts, and many CPAs and tax attorneys also prepare taxes for clients. Be aware, they can only work with what data you give them, so be sure you have all your financial documents ready to go when you make an appointment with a tax preparer. If you're thinking of using a tax professional, this slide lists some points to consider. How well trained the person is, how high the fees are, and how are they determined. Fees can be very high, running into the thousands of dollars for a complex return. Does the preparer suggest deductions you aren't comfortable with? Will the preparer represent you if you're audited? Is this their main business or a sideline? There's a National Association of Enrolled Agents and another for tax professionals. Let me say again, be aware. They can only prepare a return based on what information you give them. Giving them full information is up to you. If they make an error, it's your error once you sign the return. The text recounts the results of a test run by Money Magazine. They gave the same data on a fictional family to 41 tax preparers. The results: the cost ran from $375 to $3,600. The tax owed ran from $31,846 to $74,450. Be especially leery of tax refund anticipation loans. These are very high-rate, short-term loans and should be avoided. So what if you get audited? If you've kept good records and receipts and filed correctly and honestly, you should be in good shape. From your text, this exhibit lists the most common errors in filing a tax return. The majority of these can be avoided by using tax prep software, which error checks your return and walks you through correcting any errors found before allowing you to file. These points apply to paper returns only. The big one: be sure to sign it, and sign your check too. Make sure you've entered numbers on the correct lines, and be sure to attach your W-2 forms and any supporting schedules. The odds of being audited are very low for most of us, and in fact, tax prep software offers an estimate of your potential of being audited and why. There are 3 types of audits in increasing degrees of severity. A correspondence audit just means the IRS writes to you asking for further information. An office audit requires you to appear with your preparer or attorney at an IRS office. A field audit is the most serious and involves IRS agents coming to your home or business to review all elements of your return and your supporting documentation. If you're notified of an office or field audit, you may request time to prepare. You can ask that the IRS specify exactly what's being questioned. You have the right to appeal. It's up to you whether you bring your tax preparer with you or not. Be on time. Only bring what the IRS is asked about. Be sure you understand the relevant tax law that you're being questioned about. This is like giving a deposition. Answer only what is asked, calmly, in as few words as possible. Yes or no if you can. Our final topic for the chapter is tax planning strategies. We want to practice tax avoidance. We only want to pay what we owe, no more. This requires understanding tax laws and their impact on our financial decisions throughout the year. Tax avoidance is perfectly legal and desirable. Tax evasion is illegal. Most commonly, this involves not reporting all income. Remember, income is not negotiable. You have 3 ways to use higher education expenses in your taxes: tuition and fees deduction, or 2 types of education credit. The tuition and fees deduction allows a reduction in AGI by a maximum of $4,000. The American Opportunity Credit allows a credit up to $2,500, but you've got to be enrolled at least half-time, and it's only good for the first 4 years of post-secondary education. The Lifetime Learning Credit is limited to $2,000, but it can be used for part-time and graduate school, and you can use it beyond 4 years. You need to look at these and figure out which you qualify for and which would be the most attractive in terms of tax reduction. The buying decision most directly affected by taxes are the purchase of a residence, the use of credit, and healthcare expenses. Probably the best tax shelter for the average taxpayer is buying a home. Mortgage interest and property taxes are deductible. Years ago, all interest on debt was deductible. Now only mortgage debt is deductible, but you can take a home equity loan or a second mortgage and use the money for any purpose while still deducting the interest. Be aware, though, these are not to be used frivolously, as you have put your home up as collateral. Healthcare expenses are also deductible with some pretty stringent limits. Health savings accounts, flexible spending accounts, and expense reimbursement accounts provide a way to reduce taxable income when paying medical and child care expenses. If you have significant expenses in these areas, it would pay to check into these deductions. Investment decisions can also affect your taxes. Municipal bonds offer a tax-exempt investment opportunity. Interest is exempt from federal tax and usually from any state tax in the state in which the bond is issued. Tax-deferred investments allow you to defer paying taxes, with the usual goal to pay taxes after retirement when you expect your rate to be lower. Tax-deferred annuities, health savings accounts, IRAs, and Keogh plans fall in this category. Generally, you're not taxed on the gains in a stock or bond investment until you sell the asset, capital gains. and the rate on assets held more than a year is lower. There are both tax advantages and disadvantages to self-employment. You can deduct health and life insurance, but you have to pay a self-employment tax covering Social Security and Medicare. If you have investment accounts for your children, they're taxed at either the parent's rate or a child's rate, depending on the child's age and the amount of the investment income. A major tax strategy for working people is the use of tax-deferred retirement plans, such as an individual retirement account, IRA, Keogh plans, and 401k plans. With a traditional IRA, amounts contributed each year are not taxed, but withdrawals are taxed as gross income. Annual contributions are limited to $5,500 per person, with larger amounts allowed for those over 50 so they can catch up. There's a penalty for withdrawals prior to age 59 and a half unless the funds are because of death, disability, or for medical or higher education expenses. Required withdrawals begin at 70 and a half. With a Roth IRA, the contribution is not deductible in the year made, and the limit is the same, but earnings on the account are tax-free after 5 years. Withdrawals are exempt from both federal and state taxes. SEP IRAs are for self-employed individuals. 401k plans are employer-sponsored retirement plans that allow a tax-deferred amount up to $19,500 in 2020. Those over 50 can contribute larger amounts, as with traditional IRAs. Some employers match contributions up to a certain amount, and that makes a 401k even more attractive. Tax advisors recommend contributing as much as possible to 401ks or Keoghs, since the value accumulates on a tax-free basis until withdrawn, and the contributions are tax-deductible in the year made. Another tax strategy involves the use of education savings plans, such as Coverdell Education Savings Accounts and 529 plans. Coverdell Education Savings Accounts are designed specifically to help parents with income under a certain level save for their children's college education. Contributions are limited to $2,000 a year. They are not tax-deductible, but the funds can be used for educational expenses, kindergarten through college. Finally, 529 plans are state-sponsored plans to assist parents in saving for their children's education. There's no tax deductions, but the funds grow tax-free and they're not taxed when withdrawn. Tax laws usually change to some extent every year, so you need to keep up with any changes so you're ready when filing time comes. Recent changes include employers now allow employees with healthcare flexible spending accounts to carry over up to $500 of unused funds, streamlined options for home office deductions, qualified business income, also known as a Section 199A, allows owners of pass-through businesses to claim a tax deduction worth up to 20% of qualified business income. Anytime tax reform is discussed, the idea of a flat tax or a VAT, a value-added tax, comes up. A flat tax would apply the same percentage to all taxpayers. This truly would be postcard filing, but for many it would result in higher taxes paid, since most, if not all, deductions would be eliminated. A value-added tax adds a tax to a product at each stage in its manufacturing process. These are very popular in Europe. The idea is that higher income taxpayers would pay more since they consume more. VATs usually start low, but they've had a habit of quickly rising. For example, some of the higher current standard rates: Austria, 20%, Denmark, 25%, France and the UK, 20%, Italy, 22%, Greece, 24%. This ends our coverage of taxes and summarizes the chapter. To meet Learning Objective 1, we reviewed the major types of taxes we pay, with special attention to federal income tax. Learning Objective 2, we covered how to calculate taxable income and the amount of tax owed. Objective 3, actually preparing and filing your federal income tax. And finally, we covered various tax planning strategies aimed at legally reducing the taxes you have to pay. This ends our coverage of taxes.